Hi, this is Randy Finney with Right Side of the Chart, and this is a market recap for Tuesday, November 6th, 2018. I'm going to keep this one restricted to members of the site. I wanted to share some of the trend indicators I use, so this video will be a little bit different. These are things that I've shared on the site in the past many times, but I know we've have some new members on board, and I think it's an important time to visit the trend indicators and look at things a little bit different. Most of what I've been covering lately has to do with trend lines and price resistance levels, horizontal price support and resistance levels. So today we'll talk about trends and I think especially these long-term trend indicators I use, I think long-term investors, less active traders, trend traders will find these really useful. I'm talking 401k money, retirement money, long-term funds, because the long-term trend indicators, in my opinion, just do an excellent job of helping define where the primary trend is, whether the primary trend is a bull or a bear market. So not just the short-term stuff. So we'll get into that in a second. I'll speak to the pros and cons of the short-term versus long-term indicators. But let's do a quick wrap up today. I pointed this out in the trading room earlier. Here's QQQ. This is a daily chart, and QQQ continues to struggle with that key 200-day moving average. With the volatility, there's been a couple pierces through there on the daily chart, but as you zoom in, and again, these are daily candlesticks, you can see today, look at that run up to the 200-day, almost a perfect test. We actually had a perfect test on the S&P 500 today. So what I do when I click on the crosshairs, you'll note the pop-up box to the left will show the high of the day under QQQ in the white letters towards the top below the date. Then you have the ticker symbol QQQ. The high was 171.19. You go down a few more columns to the red line, and you can see the 200-day came in today at 171.10. So a nearly perfect kiss of that level. Now, what does that mean? Well, a couple things. Number one, that so far that has capped. We've had some intraday moves and even a couple, daily close above it there. But with all the volatility, as I said lately, the norm is to have these swings. You're going to swing a little bit above and below these levels. So, I look at it this way: bullish if we can take it out with conviction, as well as the S&P 500. We need to see S&P 500 also take out its 200-day. Not to say that we don't need to still look at some price resistance levels because they also do matter, but as of now, that's what I'm looking at on QQQ. We can see numerous failures so far at the 200-day. There was a near perfect failure. Here's we took it out intraday and then closed right on it. So you can see it's really doing just a heck of a job. Look at another candlestick body that closed right on it that day. And so that's one thing I'm watching there. And you can also see that downtrend line. Same thing I showed you on the 60-minute chart. Let's look at SPY real quick. SPY, even more impressive today. If I put the crosshairs on today's candle, same pop-up box to the left, it tells me that the high of the day, the high or the close on SPY, I should say, where we closed today was 275.12. The 200-day EMA was at 275.11. So almost a perfect tag, 1 penny off. Parked it right on that 200-day. You can see how well it's done. And again, so these are levels, and that is a trend indicator. Moving average, it helps define the trend. And so far, this is a level that both bulls and bears, sellers, we had a pretty big, we had a pop up in the morning, especially on QQQ, and then a fade, faded all of the gains, 100% plus on QQQ. Let's look at that real quick. This is another thing I shared in the trading room today. The bigger picture is this. We broke out of the downtrend lines. We had everything in place, the bullish divergences. And what I wanted to point out, someone in the trading room asked other traders, "Hey, how are you doing lately?" Well, as far as returns go, this is a sideways market, and this is back from last Wednesday. So now nearly 1 week of trading has been completely sideways in this trading range. And this is not when swing traders make money. That's why the official trade ideas have been light. That's why I've suggested keeping it light because you can't squeeze water from a rock or blood from a stone, meaning you can't extract a lot of profits from a sideways choppy market. Swing traders like these trends. You want to be short on downtrends, long on uptrends, short on downtrends. That's swing trading. It's like investing in fast forward. And so far, that's what we're looking at for the recent trend there. And here is SPY, the S&P 500 tracking ETF. Same story, pointed out many times. We had these nice downtrend line, bullish falling wedge patterns, and they've played out so far. But again, the trading, and I mentioned this as well in the trading room, when you're trading intraday time frames, of course you want to watch the key levels. That's resistance. This is the recent trading range over the last week or so between 270 and 275, pretty well defined. You can, buy pullbacks to 270. You can, uh, take profits or go long and ride it up to 275. Sooner or later, we'll break out one way or the other, and then the next logical resistance, if we get up there, would be that level. Now, the point I wanted to make, a couple things. Don't When trading, don't get lost. It's sometimes easy to get lost in the world of the intraday charts, 15-minute, 60-minute charts. But if you don't forget to look at the bigger picture. I started with the daily chart. If you're just watching this chart, well, in this case, we happen to have 275. But again, the 275 resistance has been solidified lately because we've had more reactions there. But again, remember, you're running in, this is S&P 500 or the SPY running into the 200-day moving average, as it probably was back here and here. Those are the daily time frame. The levels on that chart are much more significant than the shorter term time frames, but best when you can align all the time frames. So that's what I wanted to point out. So either way, a solid break above 275. Intraday won't mean too much, although it could spark a rally up to here. But a solid close above there will have taken out the 200-day. Now, a failure, of course, would be bearish. And if there's a lot more to come in this correction, then this would be a logical place to see this rally fail. So far, it's stalled out here. I didn't want to spend too much time on intraday analysis, but let's just look at this. As I'm on the S&P 500, you do have some negative divergence. You have the SPY making equal highs with the indicators making lower highs. So that could play out tomorrow for some downside, or maybe even a little pop to the upside before a reversal if those divergences are going to play out. So let's keep an eye on that. Okay, now moving back along to the trend indicators. This is a monthly chart, a very long-term chart going back to the late 80s in SPY, in the S&P 500 tracking ETF. It has been around that long. You can see these are the bull market uptrend lines. We've had three major bull markets during that period of time. This one was the dot-com bubble that popped back in 2000 highs, 2007 bull market top, and you can see that they all coincided with nice, well-defined uptrend lines. Here's our current bull market. Some people consider this a separate bull market. The S&P 500 and the Nasdaq 100 just barely missed the 20% pullback threshold to consider it an official bear market. But we did have a bear market. Small caps, mid caps, a lot of other things did drop over 20%. Either way, it was a 2 years of sideways trading, called a deer market. But then here's a trend line off the early 2009 lows, and that's our current bull market uptrend line, which we're still flirting with on this chart on this monthly basis. We haven't given it up. That candle there has taken us down, at least the way I have it drawn here. Now there's something else on this chart to note. And that would be, here's a trend indicator. It's simple but effective. I think highly effective for, just a single moving average. It's not a pair or anything else. It's the 20-period exponential moving average. And as you can see, going back for decades, it has done, what I consider to just be a bang-up job. This was a bear market, or at least I believe a 20% drop or close to it in the past, and it did take us below it. But other than that, just look how many reactions, look how well, and sometimes you get a monthly, intra-month pierce, possibly a monthly close below, but most of these pullbacks to it, you might have pierced that line, that EMA intra-month, but all that matters if trading on a monthly time frame or how the monthly candlestick close. So if it's, today's November 6th, no matter what happens, we still have plenty of time before the end of the month. So even if we pierce down below there, you want to see how it closes. So here you had a solid red close below, and you can see this was up to the point, I believe, the longest bull market in history until this one came along, and that marked the end of it. And so this is very simple. If you're not a very active trader, you want to know what to do with your 401k money, when to finally get out of the market. This thing has done a pretty darn good job, and as you can see, once that we fell below there, it did a pretty bang up job of capturing or telling you we're in a bear market until this point. And then you had a bullish crossover, and just look how well that trend line has defined and capped all the pullbacks to say bull market, stay long, and then a big red candle. You didn't just limp through it. You had a clear sell signal back right after the 2007 high, and that's what I wanted to speak on. I don't want to digress too much, but the pros and cons between the long and the short-term indicator. The short-term trend indicators use faster moving averages. And what they're going to do is they're going to get you in and out of a position a lot quicker. Where if you're waiting for a monthly trend indicator like this to tell you're on a sell signal, I can tell you this right now, it will most likely be several months after the market has topped. So you're not going to get short at the top. You're not going to get long at the bottom. You can see here, especially on a bear market. Bear markets go very fast and sharp. And it took, you can see several months before we got back above there. But with that being said, if you simply just traded off this, bought this, we're long the SPY, as long as it was above this 20-month moving average, and then short, you wouldn't have captured every bit of every move, but you would have captured the bulk of every bear and every every bull market and every bear market. So you can see, and again, a couple little whipsaws in between, but overall on balance, just one heck of a job in my opinion. And here it is on QQQ. Show you a different board if I have a cleaner board here. Well, that one's fine. Same thing. Look at that. Bull market, bear market. Bull market, hugging that. Look at that. 20-month moving average. Bear market right here. The scaling's down here if you're not following, if I'm talking too fast. You can see, remember, this bear market, the last one was from October 2007 to March 2009. This one was from March, the NASDAQ, which was the king of the bubble, peaked in March of 2000, and that bear market ended somewhere around late 2002, I believe. And so those are your bear markets that we've had in the last couple decades here. And the next one is to be determined, but you can see that this will help be our guide. So there's one trend indicator I wanted to pass along to you. Extremely simple, yet very effective, especially for its simplicity. That's the beauty of that one. Okay, now moving on, I'm just going to share a few more with you. And I have these trend indicators drawn up on a lot of different indexes, but we'll just stick with the two big ones, the large caps, the S&P 500 and the NASDAQ 100. Large cap stocks make up the vast majority of the stocks in the or market cap. That is, not so much a number, but as far as the total stock market value, the small and mid caps and micro caps, everything combined, pale in comparison. So really, the large caps are going to determine where we're going to go, and we can look at S&P 500 alone, but we'll look at the NASDAQ 100 as well. A lot of people like to track that, including myself. All right, so what we're looking at here is about 21-year chart. So we're spanning back a couple decades here. And here's another very simple yet effective trend indicator. This one, as well as all the other ones we're going to look at now, entail they entail a pair of moving averages, or I use a filter as well down here, which I'll get to in a second, the ROC, rate of change. And so the pair we're using here is and they're all EMAs. My preference, I like to use exponential moving averages. I will use simple moving averages sometimes. Really, whatever security behaves better too. But as far as these trend indicators, I like the EMAs because you're using exponential moving averages. They tend to react quicker than the simple moving averages, so it gives you a little more heads up. So this one is a 6 EMA and a 10 EMA, and we're on a monthly scale. So that means 6 period on the monthly and a 10 period on the monthly as well. And what you're looking at, you can see the EMA, the 6 is in blue, the 10 is in red. And what you're looking for is simply bullish and bearish crossovers. That's it. When the faster moving average, which is a 6-period EMA, crosses down below the 10 period, that's a bearish crossover, and crosses above, that's bullish. Now what I've done, and you can replicate this on a chart, if you take a simple MACD and you take the usual setting is 12, 26, 12. No, I said that wrong. 12, 26, 9. The 9's EMA. So you take that the EMA out of there, make that a 0, and then just plug in your parameters on a moving average, two moving average pairs. The MACD histogram, and that's what I'm using here, will actually give you a visual representation of when these two lines cross. So it's a very simple tool because when you look at the lines, it might be they're very close together. You might not see where the exact crossover occurred, but again, by putting that MACD and customizing it the way I did there, it's going to show you when the MACD histogram crosses from green to red, crosses down below the 0 line, it means these lines have crossed. So What I've done here is showed you the crossovers. This is again 2 decades with a very few exceptions. There's a little bit of a whipsaw, but here's my filter saved us here. So what I've highlighted here down below at this point right here, this is the S&P 500 right here. S&P 500, this black line, this is the rate of change 13, and here's your EMA pair. So there's a histogram. So what you want to look at here were the bear markets and bull markets in the S&P 500. Everything in red right here is when the histogram went red. It told you the trend was bearish, and you can see it did a pretty good job. It didn't get you in right at the highs, but it told you when it's green, you're in a bull market. Stay long. You were long here. You didn't get right at the top. Remember, this is a monthly indicator. We're going to work our way down to weekly and dailies here in a second. But there it is. So this one kept you short. The shading I did here is when it signaled that sell signal and it kept you short throughout or out. If you don't trade stock short, that's fine as well. It told you to take your stock portion out of your 401k or reduce that or hedge up, and you avoided almost all of that bear market, and it got you in long at the next bull market. It got you out shortly after the top. Didn't get you out on the bottom, but not too far from it. Kept you long the entire bull market with one little whipsaw signal here. And again, when we look down below, and it's still telling you right now the primary trend is up. As I've been saying lately, my longest term trend indicators remain bullish. But this ROC 13, sometimes I'll change it to an ROC 12. Again, that's called the rate of change indicator. Most chart services have that. Just does a great job. And here's a zero line in the middle, this dotted line. So you can see right here, it came back. It looked like it was going to signal a sell signal, but we didn't have a sell signal on the moving average pair or the ROC 13. It bounced right off the zero line. Because again, when it's above zero, the trend is bullish. When it's below zero, like here, the trend is bearish. So that's a confirming signal. And so your buy signal or get out of your shorts was right here on the EMA pair, and it came shortly after on the ROC 13. Right here, the EMA pair signaled it first, shortly after the ROC 13 crossed. And again, they're going to come in close together. But where it really helps is here was a little whipsaw signal where the EMA pair crossed over very briefly and very shallow. You can hardly make it out on this chart here. But the ROC said, don't go short, stay long. This wasn't even close to confirming. Then these turned green again. And back here, same story. It sort of bounced off the zero line. There was a little bit of whipsaw, and that was that sideways deer market, or some call it a bear market, back in 2015. So it's not as if these were, very bad whipsaw signals. At the very least, they said, okay, things aren't clear. When trend indicators start whipping back and forth, and you're in a sideways grind, and I've said that many times, when you don't want to use trend indicators is in a sideways market. Stay away from them. They're going to chop you to pieces. You want to use them during a trending market to catch these tops and bottoms when you have a strong uptrend or a strong downtrend. So there it is. Again, the primary, if you will, trend indicator here with a secondary trend indicator. You can use standalone, or I like to use it to scrub. In other words, when both signal, you have a higher probability sell signal, or buy signal, works both ways. Oh, and finally, before we move on from this chart, I'll go through the rest a little faster because now I've explained how the EMAs work, the histogram down below, and any filters that I have. The other thing worth noting are divergences. Divergences work just as well on histograms as they do on, you see me use them a lot on the RSI or the PPO on my daily chart, or MACD, but you can also use them on histograms for things like these moving averages, because this moving average pair here is very similar to the MACD and the PPO, which consist of moving averages. They just have a scrubbing signal line. And what I'm getting at here is when you see the stock market, this is what we're looking at, this versus this. When the stock market is moving up, and in this case, let's see, where did I have it? Not so much on this one. Doesn't work that good on the monthly. I drew these. There were no divergences against the indicators here, but we do have, for the first time in decades, negative divergence between the histogram here, meaning these lines right here, the histogram, and price. I'm going to get down to the weekly and dailies. You'll see that these actually work a lot better, both bullish and bearish divergences, foreshadowing the crossovers and the reversals. So sometimes you can get a jump on a buy or sell signal, or a heads up that it's most likely coming if you get these divergences first. But again, doesn't work that well on the monthly, as you can see here, but it does on the weekly and daily. Okay, I won't spend much time on this. This is the same chart, same EMA pairs. This is a, oh no, I jumped over to weekly. Let me go back to the monthly. And there she is. All right, this is the Nasdaq 100. Same thing. I just showed you the S&P 500 with these using the same trend indicators, and you could see same story. There's where they cross. There was your sell signal down below. Remember, this is the Nasdaq 100. If you're wondering where prices went, again, didn't catch the top. That was a big top. That was the big bubble leading up to the dot-com bust in a pretty vicious bear market. But again, it kept you short throughout most of it, and it also got you long towards the bottom. That was a bull market. May not look like much because the scaling here throws it off. This has been such a large move, as was the one leading up before, but that was a bull market in itself, multi-year bull market. There was a great recession, the bear market 2007 through 2009, and as you can see, got you short near the top and got you out near the bottom, and has told you without any ambiguity, no false sell signals, is said you're in a bull market, stay long. These haven't even produced a whipsaw signal since. That's a pretty bang up job. We're still pretty far, solidly. Again, this is a monthly chart into bullish territory. But usually when you see this line cross down the slope of that faster EMA, that 6-period EMA go down, usually a bear market's coming. It turned down right here and had a little pop back up, but it never recovered, and a bear market began. So you can sometimes look at just the slope of a moving average, and if the slope is positive, meaning the line is pointing up, that's a positive slope. That's flat, no slope, that's a negative slope. And you can use the slope sometimes to predict, the trend or impending trend change. All right, now moving on, just try to wrap this up a little bit quicker. Here's the NASDAQ 100 on a weekly trend indicator. I like to use this has a 17 and a 43 period EMA. You can see them up here in the corner. 17 is your fast EMA, the 43 is a slower EMA. These dotted lines, what the black lines here and here, I wanted to point out that nothing is perfect. As good as some of these trend indicators are, there are whipsaw signals, and that's what it's showing you. And the whipsaw signals really weren't so bad. You didn't lose a whole lot. You just got in, it gave you a sell signal, and then turned around, the market went up, and you maybe lost a little or got about out where you were. But other than that, and again, I just showed you the whipsaw signals, and this goes back over 2 decades. Sell signal, short or get out of your longs, stay short until this point, buy signal. And again, because we're moving down now to faster EMAs, this is a weekly chart with faster EMAs. They're going to give you your buy and sell signals a little earlier than that monthly chart. But the downside is the trade-off, you're going to be prone to a few more whipsaw signals. And like everything else, I don't use any single indicator, trend indicator, anything else by itself as a standalone buy or sell signal. I use it in conjunction with everything else, all the other analysis that I cover on a daily basis. And then it all gets factored in. But there it is, sell, get out. That was the bear market from 2007 to 2009, and it told you were in a bear market. No ambiguity there either. And then it was bullish with one whipsaw signal throughout this entire bull market, and still is. Again, this is a weekly trend indicator, and you can see the same thing if we go to the S&P 500 weekly. Oh, got a couple here. I believe it is this one. Yeah, needs to fill the screen. There it is. Okay, same thing. Look at the lines. Go short, go long. Go short, go long. And that is, again, 20 plus years. Every bull and every bear market that we've had for the last 20 years, which are, of course, only 2 bear markets, 3 bull markets over that period. And you can see a very, very good track record. You can pause the video, check it out. There was a little bit of whipsaw. Again, I already talked about that 2015 sideways deer market, bear market, if you want to call it that. And that's when you had the last sell signal. So, and here's where I mentioned earlier, you start to see the divergences really work well. On the histogram, you can see the histogram divergence, negative divergence. I'm referring to the market prices, meaning the S&P 500 moving higher, with the histogram moving lower. That's negative divergence, and that foreshadowed this crossover. We had negative divergence right here. It foreshadowed this crossover, and that was, by the way, at the beginning. That marked the beginning of the bear market back in 2007 that started in October. So you had divergence leading up to that. Told you at that point, just like recently, even if you don't want to bother trying to nail the top, get out. The risk reward is not very good when you see that. That's what I was talking about all year before this top even came, that the risk reward just wasn't worth it after those first two corrections that we had, and those divergences on the weekly and everything else expanding. And you can see what happened. For those that didn't heed that warning, this correction came so fast and caught a lot of people off guard. But again, it was priced in. It took a while for the divergences to play out. Sometimes they take months, sometimes they can even diverge for years. But more often than not, they do play out. So again, weekly chart, and now we go down to our dailies. Okay, we only have two more to cover, two more trend indicators. This one, the 50, 200 day. This is a big one. A lot of traders will use a 50, 200 day moving average. And just, terminology, when you have any moving average pair, it doesn't have to be the 50, 200. A lot of times there's confusion on that, but I'm referring to what the terminology, when the fast line crosses, or the faster EMA or moving average, could be a simple moving average. The faster moving average crosses down below the slower moving average. In this case, the 50 crosses below the 200. They call that a death cross. And when it has a bullish crossover, it's called a golden cross, just so you know. So again, just terminology, vernacular, but there it is. You can see the divergences I talked about. They work well on these daily and the weekly charts. And the same thing with divergent lows. You want to catch the bottom of the bear markets. They were all in this case, we had two bull markets in the span. This one already started to the left of the chart, and both of those were preceded by positive or bullish divergence between the S&P 500 and this custom histogram I created here to show you the 50 and 200 day moving average when they cross. So you can use that as a tool, and you can see all the divergences marked that preceded the highs. Gave you a heads up that you didn't have a cross yet, but you were probably going to get one. You had one there, and again, just to reiterate, these were the bear markets right here. Bear market, bear market. Well, we haven't had one since, and you can see it told you were in a bear market. And again, we're getting down to shorter term EMAs. So yes, you're going to see a little bit more whipsaws. There's that period back between 2015 or around 2015 or so. But again, it's done a pretty good job. And what concerns me right now, you can see how rapidly, how sharp that 50 days coming down right now. We haven't seen a turn down like that. Such a sharp move down after it was pointed up for a while. I'm going back here for a while. I don't see. We had a drop here, but it wasn't as sharp as that. So this one's concerning. We don't have the crossover yet, but when we get it, keep in mind, look for it on S&P 500, look for it on the NASDAQ 100 as well. I'm sure I'll point it out at the time, but that might help tell us that, hey, we may be in the start of a new bear market or a downtrend with more to come. And just quickly, the same thing. I just showed you the S&P 500. This is the same 50 and 200 day. And again, you can see when it told you the trend was bearish, which was in this case the two bear markets that we've had in the past 2 decades, and everything else was, for the most part, with a few whipsaw signals, was green, saying you're in a bull market. So watch it. This is what we're watching for right now on that particular trend indicator. And then finally is the last one here. This is a little faster one. This is also a daily chart, and this is the S&P 500. Again, this one's going back 12 years. No reason to go back much farther. And I'm using the 20 and the 50 day exponential moving average. And like I said, you're going to have some more whipsaw signals. I put little X's here where you had whipsaw signals, but you probably want to screenshot this chart. I'm sorry, pause the video and take a look closer. You can see my notations. But for the most part, what I'm showing you here are the green boxes, and the red boxes show you where the crossovers were. In other words, I put dotted lines. I took the time to put horizontal lines, a red line indicating a bearish cross, like you have right here, and a green line indicating a bullish cross. So if you're trading off this particular, using this to confirm your trades, let's say to confirm the trend, when the histogram is green, the trend's bullish, and when it's red, it's bearish, or in this case, it looks brown, but You get the point. And you can see now we've been in a bull market. And therefore, you would expect, and as this has given you a lot more periods where it's green, telling you the trend is bullish. But going back, I did cover the last bear market, and you can see it's just done a great job. It kept you short or out of your longs most of the 2008 bear market. There was a top in October right there. I can tell you it was sometime in October of 2007, and you only had, and there was a counter trend bounce, and this trend indicator would have got you in quick enough where you could have been profitable. You could have jumped out of your short sidestep. That was a pretty powerful bear market rally. So there it is. It's done a great job, and I can show you the same thing on the Nasdaq 100, and we'll wrap the video up. Okay, this is the Nasdaq 100. I had a couple crossover lines back here. I haven't updated it recently, but same story. And you can see again, this is I don't want to say my shortest term trend indicator, but on the daily time frame it is. And I use this in one of two ways. The slope of the 20-day exponential moving average, which is the blue line, we have the 20 and 50. When the slope of the 20-day is pointed down, the trend is bearish. It's simple as that, and it really doesn't get much easier. Right now, that's still the case. In fact, you can see even the 50 has turned down and is still pointed down despite this recent bounce. And as far as the histogram goes, it shows you where the crossovers are. It's telling us now, without any confusion, it's clear as day that this trend, and this is again a shorter term trend, is still bearish despite the counter trend bounce that we've had recently. There's the bounce right here. This is the Nasdaq 100 down here. There was a period right there. And so for the last 3 years, the only other time it gave you, we had a little bit of a whipsaw. That was a whipsaw because if you look at when it gave you the signal, you got in short here, you got out and you had a small loss. But back here, it told you get out of the market or short the market right there on the dotted line. And now, again, as I said, especially with these very short-term ones, I use this in conjunction with other things. For example, this sell signal may have coincided with a bearish rising wedge pattern, which broke down right here and got us short. And at this point, maybe we hit my final price target and we might have had some bullish divergence and other buy signals to get us out here, not wait until it crossed back over, because then you would have almost gave back all your gains. So I'll use these sell signals to confirm my trades. My other analysis is what I was trying to say. And I don't sit there and use them as buy alone sell signals. But you can. I showed you in the beginning of the video those monthly longer term trend indicators. So if you're that person out there, an investor, and you're just hearing you're getting pounded with this guy says go long, this guy says buy the dip, this guy says sell it, we're in a bear market, you don't know what to do, fall back on those longer term trend indicators. You're not going to catch the top, but they're not going to shake you out of your positions. I know goodness knows I've looked for plenty of tops in this market over the past few years, at least for corrections. And that's what I always say. I've never positioned short on any breakdown and tucked away those shorts and held on to them for the last 2 or 3 years. I traded, corrections, and I was always open, as I am with this one, always open to the possibility that any one of the corrections in the last few years could morph into something more. But to do that and turn into longer term shorts, swing shorts, you'd have to take out those trend lines, a 200-day I'm talking about, have these trend indicators slip bearish, take out major support levels. And so that could happen soon. I've given you all the levels to watch and some additional tools here. I hope you found this useful. I know it's a long video, but again, I think these are worth having in your arsenal. All right, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.